Trade payables, accruals, bank balances, and cash are fundamental elements of the statement of financial position and require extensive audit attention because they directly affect liquidity, working capital management, and financial reporting reliability. Under ISA 500 Audit Evidence, ISA 505 External Confirmations, and ISA 330 the auditor's responses to assessed risks, auditors are required to obtain sufficient appropriate audit evidence supporting the assertions of completeness, existence, accuracy, valuation, rights and obligations, cutoff and presentation. Unlike receivables, where overstatement is often the primary concern, the principal audit risk for payables and accruals is understatement, as management may intentionally omit liabilities to improve reported profitability and liquidity. Conversely, bank and cash balances are highly susceptible to fraud and misappropriation, making external confirmations and reconciliation procedures particularly important sources of audit evidence. The primary audit objectives for trade payables and accruals are to verify that all obligations existing at the reporting date have been completely recorded, accurately measured, and appropriately classified within the financial statements. Auditors seek assurance that liabilities represent genuine obligations of the entity, relate to the correct accounting period, and have been measured in accordance with the applicable financial reporting framework. Particular attention is given to completeness because omitted liabilities may materially overstate profit and financial position. Audit procedures therefore emphasize identifying unrecorded liabilities, reviewing post-year-end transactions, and evaluating management estimates relating to accrued expenses and provisions. One of the most effective substantive procedures is the preparation and review of supplier statement reconciliations. Supplier statements received directly from suppliers are reconciled with the client's purchase ledger to identify unrecorded invoices, disputed balances, timing differences, or recording errors. Any discrepancies should be investigated through inspection of purchase invoices, goods received notes, payment records, and correspondence with suppliers. Where supplier statements are unavailable or where material balances exist, auditors may obtain direct confirmation of accounts payable by requesting suppliers to confirm outstanding balances at the reporting date. External confirmations provide persuasive evidence because they originate from independent third parties and support the completeness, accuracy, and existence of liabilities. Although payable confirmations are less common than receivable confirmations, they are particularly valuable where internal controls are weak or understatement risk is significant. Additional audit procedures provide further evidence regarding payables and accruals. Auditors inspect purchase invoices, contracts, supplier correspondence, and goods received notes to confirm that liabilities relate to goods or services received before year-end. Examination of payments made after the reporting date assists in identifying liabilities existing at year-end but omitted from the accounting records. Review of unmatched goods received notes and unpaid invoices identifies potential accruals requiring recognition. Analytical procedures comparing payable turnover ratios, expense trends and gross margins with prior years or industry averages may reveal unusual fluctuations indicating omitted liabilities or incorrect expense recognition. Recalculation of accrual estimates and examination of supporting schedules further support valuation and completeness assertions. Other current liabilities such as tax liabilities, provisions, customer deposits, deferred income, and loan interest accruals also require substantive audit procedures. Auditors inspect tax returns, legal correspondence, loan agreements, board minutes, and contractual documentation to confirm the existence and measurement of obligations. Review of subsequent payments, settlement agreements, and post-year-end events provides additional evidence supporting recorded liabilities and identifying unrecorded obligations. Particular attention is given to contingent liabilities and legal claims where management judgment significantly influences financial statement presentation. Adequate disclosure of current liabilities in accordance with the applicable financial reporting framework is also verified through review of financial statement notes. The audit of purchases and other expenses, including payroll expenditure, focuses primarily on the assertions of occurrence, completeness, cutoff, accuracy, and classification. Auditors examine purchase orders, supplier invoices, goods received notes, and authorization procedures to confirm that expenses relate to genuine business transactions and are recorded in the correct accounting period. Cutoff testing around the reporting date ensures that purchases are recognized when ownership transfers, rather than when invoices are received or payments made. Payroll expenses are verified through inspection of personnel records, employment contracts, payroll calculations, tax deductions, pension contributions, and bank transfer records. Analytical procedures comparing payroll costs with employee numbers or production levels may identify unusual fluctuations suggesting payroll fraud or recording errors. The audit of bank and cash balances is particularly important because liquid assets are highly vulnerable to theft, fraud, and management manipulation. The principal audit objectives are to verify existence, ownership, completeness, valuation, and proper presentation of cash resources while identifying undisclosed borrowings or restrictions affecting cash availability. One of the most persuasive forms of evidence is the bank confirmation report, obtained directly from financial institutions under ISA 505 external confirmations. Bank confirmations verify account balances, loan facilities, overdrafts, pledged assets, contingent liabilities, guarantees, unused credit facilities, and other banking relationships that may affect the financial statements. Because this evidence originates independently of management, it possesses a high degree of reliability. Additional evidence relating to bank balances includes examination of year-end bank reconciliations, bank statements, cash books, electronic payment records, and subsequent bank transactions. Auditors recalculate reconciliations independently, investigate outstanding lodgements and unpresented checks, and inspect unusual reconciling items for evidence of manipulation or misstatement. Review of transfers between bank accounts near year-end assists in identifying window dressing or cash kiting schemes. Examination of loan agreements and financing arrangements ensures that all banking obligations and restrictions have been appropriately recognized and disclosed in the financial statements. Audit procedures relating to cash on hand focus primarily on existence and safeguarding. Auditors may perform surprise cash counts, inspect petty cash records, reconcile physical cash to accounting records, and examine supporting vouchers for cash disbursements. Petty cash impress systems should be evaluated to ensure appropriate authorization, segregation of duties, and periodic replenishment procedures. Cash receipts should be traced to bank deposits, while cash payments should be supported by authorized documentation and independent approval. Where foreign currency cash holdings exist, auditors verify exchange rates and translation procedures to ensure accurate valuation. Analytical procedures comparing cash balances with previous years and expected operating requirements may identify unusual fluctuations requiring further investigation. Through the combination of supplier reconciliations, external confirmations, inspection of supporting documentation, analytical procedures, recalculations, bank confirmations, reconciliation testing, and physical cash verification, auditors obtain sufficient appropriate evidence regarding payables, accruals, bank balances, and cash. These procedures provide assurance that liabilities are complete and accurately recorded while confirming that cash resources genuinely exist, belong to the entity, and are fairly presented within the financial statements. Comprehensive auditing of these balances is therefore essential to maintaining confidence in financial reporting and supporting the auditor's independent opinion.